Okay, I'm going to invite our guests to come up here.
My name is Merv Miller. I'm a local attorney, estate planning and elder law. I'll talk in a second about what elder law means. MJ Miller Law Offices, off of NCS Boulevard and the freeway. Was there something else I was supposed to say?
Well, I'll tell you what, if you'd like to, just...
So I've been doing this, I like to say, I've been doing this since before dust was invented. But I'm a certified specialist in estate planning, trust and probate law by the State Bar of California. That's it. I'm going to turn it over to you. Go ahead.
Thank you. My name is Joe LeBlanc. I'm a certified financial planner and enrolled agent. I've been in the financial service industry for 28 years, both in wealth management and tax. And so one of the things that our practice does, we're with Premier Wealth Advisors, we have kind of an integrated tax and financial planning practice. And we found it really blends well together because we help clients on both sides of the equation, and we look at a financial planning with a tax lens, and we look at a tax return with a financial planning lens, which tends to provide better results.
Hello, my name is Cole Chodorow. I'm a wealth manager also at Premier Wealth Advisors. I've been doing this for just about 2 years, so not as long as my other panelists here. But I'm working towards my certified financial planning license. Yeah.
So Rick, can I just add, since Joe showed me the ropes here? So I said I do estate planning and elder law. Estate planning, traditional estate planning is wills and trusts, and someone dies, tie up the loose ends, powers of attorney, that sort of thing. Elder law, best indicated by a short story here, 30 seconds maybe. So you need assisted living. Your physician says you can't live on your own anymore. So you call up your son and say, let's go on out and take a look at assisted living facilities and pick one for me. And you go here, you go there, you go everywhere. Finally, you say, this is the one for me. This is the one for me, right? You sit down with the financial officer, admissions officer, whatever you call it, and she says, well, our base fee is $2,000, but with your needs, it's another. And I'm pulling these direct out of blue sky, so don't get threatened. It's $6,000, so the total is $8,000, and you've got $2,000 to your name. You don't want to put a burden on your son who's sending his kids to college, and he's got to pay for those tuition. And you know that your daughter, that SOB daughter, isn't going to contribute a penny. So what do? I'm the guy that you consult to figure out how to get government benefits to pay for that. Okay, so elder law has a lot of different meanings. For our practice, that's what it means. Okay? So we deal with Medi-Cal, we deal with veterans benefits, we deal with assisted living, skilled nursing, care, that type of stuff. Sorry.
So, Merv, maybe somebody that you'd want to talk to someday. Just early. Find out what's going on. All right, so what I'd like to do is start by discussing what documentation issues can create problems for people when they're preparing to transfer property. With me? Joe, I'm going to ask you to go that one first.
Documentation issues for selling a property or buying a property, it can be a little confusing. One of the things that we see, and Merv probably sees, is a lot of people will hold their house in a revocable trust, which generally is a good idea for estate tax planning purposes, but the escrow and mortgage people don't necessarily like that, because a bank won't lend to a trust, they lend to an individual. And so one of the things we see often is you actually have to take your property out of trust at the time of the sale, or at the time of, for instance, a refinance, and then you sell it as an individual. And then when you buy your next property, that is one of the very important steps, is making sure you register it into the trust after you purchase.
Great. Cole, this one's for you. How about, can you just talk about how to ensure the property is deeded correctly? Is that?
I would say the best way to do that is to meet with a real estate attorney. There are issues in terms of gaps That's one of the big documentation issues with real estate and transferring property is to make sure that your title and deed, there's no gaps in the line of when you bought the house and then when you sell the house. Yeah, that's one of the big issues with that.
Okay.
Well, I'll follow on with an
Yeah,
example.
I agree. What do you mean by gaps? The person over here asked that, and I agree with you.
Well, it's simply having gaps in title that it's not essentially in the wrong title for what you need. And so I'll give an example. And what usually happens, especially around refinances, as I mentioned, is a bank doesn't like your house to be registered in the trust. The bank wants to lend to an individual. And so the bank makes you take your property out of trust to do the refinance or to extend a loan on it. And then if you don't put it back in trust, that's where you get a problem or a gap. I had a client probably about 10 years ago that did a refinance, passed away a couple of years later. As we're going through the process of figuring out where all the assets are and how to transfer to the beneficiaries, discovered the house was not in the trust anymore. And so she had done the refinance, but never done the follow-up step of retitling the property to the trust. It's not insurmountable, but it is a problem. In California, if you have more than $150,000 of assets not in trust, you go to probate, which can be a problem and cost and time delay of transferring assets to the beneficiaries. There is a process to get around that, but it throws a snag in the whole process.
Great.
So, just to follow up, because you're absolutely right. One of the problems that we see is with you go out and you refinance, right? And as Joe said, escrow, title insurance, the bank, the lender forces you to take property out. So escrow creates a deed from your trust to you or you and your spouse as individuals, right? And that's okay. It's not necessarily anything to panic about, but oftentimes escrow says, or someone says, we're going to put it back in the trust for you after the loan closes and escrow closes and everything's done. And it doesn't happen, right? So that's what I refer to as it's slopped out of the trust, right? So, you got to kind of be careful about that. I mean, with our clients, we like to review their estate plan every 2-3 years. That doesn't mean everybody comes in every 2 or 3 years. That's what we like, right? They don't necessarily do that, some do. But we want to have them coming in periodically because the first thing that I do, new clients, existing clients, doesn't matter, is let's talk about what you own. I knew what you owned 5 years ago, but I don't know what you own now, and I don't know what the title is on it. Well, you own your house where you're living, right? Yeah, okay. So, I mean, I have access, I assume, Joe, you probably have access, to one of the local title insurance companies' records vaults. They call it a plant, title plant. And you can get that online, and I can see how they say that it's held in title. That's not 100% guarantee, but it's a pretty good indication. Hey, it doesn't look like it's in the trust, and then I can go a little further, or hey, it looks like it's fine. So, I hadn't heard the term gaps before, but okay.
Sorry about that.
That's okay, everybody calls it something else. I call it slopping out of the trust, okay.
One of the things that I'd like you guys to talk about is power of attorney. We run into it on the real estate side. I don't like it. I don't like dealing with it because it's complicated, but it's important. We need it. Please explain better than me.
Okay, I assume you're looking at me, so, because there's no one over there. So, let's start off with what is a power of attorney and when did it come about? Powers of attorney have been with us since Sir Lancelot's time. And they were originally created back in Great Britain or England or whatever they called themselves at that point in time. During the times of when I was at school, we always called it Crusades, right? So the armies are going to the Middle East to fight, right, or to the Holy Land. So the head of the castle, the prince, the king, whatever he is, he's going to lead the army, right? So he's gone, right? He's gone for months and months, and there's no internet, right, for him to communicate with. Didn't have that. So how does someone have the authority to order the 5 tons of apples or whatever it is, right? So we created powers of attorney. And it was solely for the purpose of someone's absent and someone else has to be in charge. Well, bring that into modern times. We want it to be effective when someone has a stroke and loses mental competence. That wasn't even on the thought process at that time. And normal powers of attorney lapse just when you want them, just when someone loses mental competence. So back in the late 70s, various states, including California, created something called a durable power of attorney. It's durable, right? It lasts through a stroke or a mental competence or springs into effect at that point in time. So what we're all talking about is durable powers of attorney, right? And it simply gives someone authority when you can't do it anymore, when you've lost mental competence or whatever. But as with anything else, there's durable powers of attorney and there's durable powers of attorney, right? So, getting back to documentation, which was the last thing we were talking about, do you have an adequate power of attorney for the purpose, right? Did you get it off the internet? Maybe that's good enough, maybe it isn't. Did you get it from an attorney who actually knew what he or she was doing? Was it from a certified specialist in estate planning, trust, and probate law? Because we see a lot of what we call statutory powers of attorney. They're by statute. This is what it reads, right? And it's got a list of powers, right? And you can, we used to say you could buy them at the stationery store. Well, now you can get them off the internet, right, for free. Uniform statutory power of attorney, California. That's your Google search term. And, it's got these powers. Real estate transactions, bank transactions, and that's defined by statute as to what each of those powers means. All right, great. But it doesn't have anything about qualifying for Medi-Cal. It doesn't have anything about making gifts, although everybody thinks it does, but it doesn't. So, those are the custom stuff that you either put into the statutory form or the attorney drafted one has in it. And that's pretty important when you've lost mental competence. You're looking at $10,000 a month for a nursing home or whatever, and you want to qualify for Medi-Cal. All of these things become really, really, really important. I didn't mean to steal the show, so go ahead.
No. In fact, I'm going to ask you some follow-on questions. So
We didn't practice that.
No, we didn't. I'm just going off the cuff here. So let's talk circumstances. And 2 circumstances I can think of. So one is a current power of attorney versus a springing power of attorney. And then the second issue, which may be more discussion, is you give your son-in-law power of attorney and your son-in-law sells the house out from under you. Could that happen?
Yes. So let's talk about the first one. All right. So we have immediate powers of attorney and we have springing powers of attorney. Immediate. This power of attorney is good right now, and if you lose mental competence, it's still good. Springing. This power of attorney has absolutely no effect. It's not worth the paper it's printed on until you lose mental competence, and some kind of trigger, that would be the trigger, springs it into effect, right? Think of a spring trap or something like that. And there's got to be some kind of proof, so we usually write in 2 physicians, one of whom is a psychiatrist, signs a written declaration that you can't handle your financial affairs, something like that. So that's the first question. What was the second one? Refresh my memory.
So you give your son-in-law current power of attorney.
Right. So nothing is perfect, okay? No such thing, not in this world. Probably not in any world. So, I had a client sitting down at my desk, this was maybe 20 years ago, and we were talking about trust, but it could have been for powers of attorney. Who do you want to be in charge if you can't handle your affairs? And she leans back, she thinks for a second, she says, well, I've got 8 kids, and I want Bob to be the one in charge. I said, okay, well, how come Bob? Well, Bob's really, really, really good with numbers and books and things like that. So we talked about it a little bit. He was so good, he was in state prison for cooking the books. I said, maybe Bob isn't the best choice, right? So, yeah, you don't name someone unless you trust them. Oh, but I don't want to have court supervision. Great. So Bob can steal everything instead of having court supervision. In other words, you got to make a choice, right? You got to make a choice based on risk, reward, conclusions, and that type of stuff. So yes, it can happen. Don't name him unless you trust him.
So getting back to this trust idea, some folks don't have a trust, and they go to probate. And I'd like anybody here to tell me which one's better, trust or the probate.
Oh, okay.
Well, it depends. If Bob is your only heir and he's in prison, maybe probate is a better option. But generally, a trust is going to be a better option because you decide ahead of time. It's, we call it pulling strings from the grave. Kind of what's going to happen, who your successors are there any requirements for when the beneficiaries can inherit assets? So a trust allows you to do a lot more in advance. But probate is not always the worst option.
Which one costs more?
Okay, so let's go back to. I'm going to avoid your question. All right, let's for a moment or two. Let's go back to what Joe said. I agree with most of that, but not all of it. A trust is a tool. It's a hammer, okay, that you can use. That's probably a miserable example. All right, so anything that you can do with a trust, you can do by other means. All right, so usually, so Joe was talking about you decide who your successor are. You can decide that by will. Who's going to get what? You can decide that by will. Who's going to get what when? You can decide that by will. But a trust, and if you lose mental competence, a trust steps in and helps out. You can do that by a power of attorney. What you can do with a trust is you can do several things at the same time, which you can't by other documentation. A power of attorney is going to avoid court supervision if you lose mental competence, right? But it's not going to decide who your successors are, or who's going to get what. So a trust is a very, very useful tool. Is it right for everybody? No. So I had a client come in last month, I guess, has no kids, leaving everything to charity. And 5 years ago, a trust was written for them. Not only was a trust written for them, but it was a type of trust that was going, probably 10 years ago, that was going to save on death taxes, okay? So 10, 15, 20 years ago, the death tax exemption was, $600,000. It's 12 million something. 12 million, 11 million, 12 million something or other now. Scheduled to come down in 2026. Don't know whether that's going to happen or not. Okay, then you get into Democrats, Republicans. Who cares? Who knows? But it's not right for everybody. Certainly, a death tax exemption trust for these people was stupid. They're leaving everything to charity. Charities don't pay tax. Okay, I don't know if you knew that or not, but they don't pay tax. You leave everything leave everything to a charity. You've got $50 billion. You get a $50 billion deduction basically on your death taxes. The official name for death tax is a state tax, but it sounds too much like state tax, so death tax. I really do know what the real word is. So it was stupid for them. Did they need a trust? I don't know. Maybe, maybe not. But they already had it, so so be it. So it's not right for everybody. And a trust. I mean, there's 1,000 different ways of configuring a trust. Death tax exemption, this, that, whatever. So it's kind of hard to say that. Your second question is more interesting, probably. Which is less expensive? All right. I think you asked it the other way, but it doesn't matter. Probate or trust? Usually, if you have a trust for virtually all of your assets, that's going to be quicker than probate. I say that a simple probate takes 10 to 14 months. That's what it takes. I used to get calls all the time from Oceanside. It was always Oceanside. Some attorney up there who I guess had a big will practice was handling a probate for them, and it was taking too long. I want you to do something about that. Well, how long has it been? 10 months. 10 to 14 months. It's 10 to 14 months. And attorneys don't make more the longer it takes. They don't get paid until the end of probate, which is really awful from my perspective. But the longer it takes, effectively, the less they make per hour, right? So, I mean, I'd like to get a probate done in 2 days if I could. 10 to 14 months. A trust, a little bit less. Most of the procedures that we have to follow in probate, we have to follow with the trust now in California, not in other states. We have to give the same basic notifications to the same people. But we don't have to go to court. All right, big deal. You probably don't know this, but there's 2 hearings in normal probate, 2 court hearings. We don't show up for any of them normally unless someone objects. They're standard and approved, and that's sort of how it works. You got to coordinate with the newspaper publication and the bond company, maybe. But it's not a big deal. But trusts do take a little bit less, and generally we charge a little bit less for a trust just because we don't have to deal with the probate court. But we don't deal with the probate court that much in a normal probate. The big problem, here's the big problem, and I've got a case right now, is where you don't have virtually all of your assets in probate. As Joe said, $150,000 outside of the trust, you can still avoid probate. It's we call it an affidavit, you'd call it a 2-page letter. We swear this is true, sign it, and the bank has to turn over the money and that type of stuff. But I've got a case, part probate, part trust. Total, we've got something like 80 different assets. They're not that wealthy. I mean, I don't know, what your relative wealth is. I'm not asking you to tell me. But it's, I don't know, 3 million total. So it's not like, they're uber wealthy, or we're uber wealthy, but 80 assets. You can imagine, and about 30 financial accounts. When I say financial accounts, I mean securities accounts, not a bank account. Bank account is easy. You get some interest in, big deal. Securities account, you've got capital gains, reinvested sometimes. You got dividends, reinvested sometimes. You got sales. You got, So trying to square all of this out in a financial report so we can send it to the 5 beneficiaries. It's taken forever. I mean, we're at 12 months right now, and I got to go to court and tell the court I need more time, Judge. I need more time. So that's the big problem. Whether you go trust or probate, I mean, everybody hates probate, except attorneys, I guess, and charities, because we do it all the time, so it's no big deal. But if you've never done it, it's, oh my God, it's the worst thing in the world. Not really, but you think it is. Yeah.
Joe, I'm going to ask you this one. What are the possible capital gains tax ramifications when selling a home after living there for many years?
So that answer has changed. Well, I actually changed kind of mid-2000s. Everybody still remembers the old rule, which was basically you got a one-time 100% exemption when you sold your house, and you had to buy another one for equal or lesser value. That rule stopped existing kind of mid-2000s. The current, because we're talking income tax here, the current income tax rule is every 2 years, each person gets a $250,000 gain exemption. And that's both at the federal level and the California level. So if you buy your house for, let's say $200,000 and you sell it for $500,000 and you're single, between $200,000 and $450,000, add $250,000 is tax-free gain. The additional $50,000 is taxable gain, IRS in California. If you're a married couple, you multiply times 2. So you have a $500,000 exemption. So in that case, if you bought it for $200,000, sold it for $500,000, it's all tax-free. So that's income tax. There's also, question?
Every 2 years, you get a $200,000 exemption?
Yes.
And does that accrue every 2 years it adds on? Like
No.
4 years it's $400,000?
So, no. That is a really good question. That's a really good question. So the requirement is it had to have been your primary residence for 2 of the immediately preceding 5 years. So if you've owned it for more than 2 years, up to 5, and you lived in it as your primary residence for more than 2 of those years, you get the $250,000 gain exclusion per person. But it's a cap, one time. The 2 years is potentially every 2 years you could redo it with the new house. So if you're, step up, step up, step up, step up, you get that gain exclusion every 2 years. It renews. Whereas in the old example, like pre-2000s, it was a one-time exemption. So this allows you more flexibility to, do those step-ups periodically and exclude gain periodically.
That's federal, not state, right?
No, both federal and state. California conforms to that. And there are some nuances in there for rental properties. It does not apply to second homes. So if you have a vacation home out in Palm Springs, that's all taxable gain, unless you move into it and make it your primary residence for 2 years before you sell it. So there's, some strategies involved in maximizing those gain exclusions, but you have to be proactive and forward planning.
Or maybe hire a wealth manager?
Yes, or a financial planner, tax professional that's familiar with these rules and strategies. Yes, good idea.
You guys all know, this stuff changes a lot, and they get paid to know it. And you can make money by paying them.
I own a home in Walnut Creek, which I'm renting out right now. So when I have to go back, if I want to sell it, I have to live in it first for 2 more years?
So that's a really specific nuance, and the issue becomes if it's been a rental and you move back into it, that rental period becomes what's called a non-qualified use period. And so there's a calculation of the percentage of gain attributable based on time to that non-qualified period versus the qualified period, meaning the 2 years that you get it. So the answer is maybe. And there are some circumstances where, yes, you could essentially end up with all tax-free gain because the math works out, but there's some cases where the math just does not work out and you have taxable gain because it was a rental and you tried to reconvert to private residence.
No.
Just to clarify for myself, so say you bought a house for $300,000 30 years ago, now it's worth $2 million. You only get a $500,000.
Correct. $500,000. Do you want to know a way around that?
Yeah, here's the question. Can you repeat?
Oh, so the question was, you bought a house for $300,000 30 years ago, which is feasible, but it's worth $2 million today, and you sell it. So between 300 and 800, assuming married couple, is tax-free. 800 to 2 million taxable, California and IRS. So that could be a lot of taxable gain.
What are the documentation requirements for home improvements?
So for home improvements, and that is part of the equation. So if you've made improvements to your house, you've added a pool, built a casita, whatever it is, that is allowable in that calculation. So it'll add to your cost basis or your tax-free amount. The IRS does not have any really strict documentation requirements until the auditor shows up at your door.
So Joe, you said that there are ways around
Yes.
her question, so maybe you'd like to touch upon those.
So not to be macabre, but in the the rental business, we have a strategy called swap till you drop. So in California, it's community property state. If one spouse passes away, you get a step up in cost basis to the fair market value. And so if you maintain your primary residence until one of the spouses passes away, the surviving spouse can sell the very next day and have goose egg, zero capital gain, zero tax.
Do you have to take it out and put it back in the trust
I
to
don't
do that?
No, that's not trust related. That's just husband and wife, community property in California.
My wife dies today, I sell the house tomorrow, I don't pay any taxes.
Correct.
Is that, do you have to?
You don't want to admit to any kind of crime, do you?
Can you explain the new 40% of the tax when you go over 5 million and you sell a house for over 5 million? You have a new is it a California tax?
No, I think that's LA. LA passed that.
It's not in the state of California?
No, it's not statewide. It's specific to LA that they passed that. I don't know what they call it.
Mansion tax.
Mansion tax. So yeah, different municipalities can pass their own rules on their residents of how they're going to tax them.
I thought if you sold a house for over 5 million, you had to pay an additional tax.
I think in LA County or maybe
Only
LA
LA
City.
County.
It might even be LA City, not LA County. So yeah, just like each municipality has their own real estate tax rates. Your tax bill if you live in Encinitas is different than if you live in Del Mar. It's different have you seen what the taxes are, real property taxes in Forest Ranch? Because they have a thing called Mello-Roos. It's almost double.
Stefan, that you were referring to, does that apply both to state and federal?
Yes, step up in cost basis is both federal, IRS, and California.
Joe, would you like to expand a little bit on tax basis, or would you like me to? Or?
Go ahead.
Okay, so, because you might not want to raise your hand and say, what the heck are you talking about? So, tax basis, and step up in basis. So you buy something for $10,000, you sell for $100,000, you made a $90,000 profit. The IRS calls it gain, we call it profit, okay? And potentially you pay tax on that, $90,000. You buy something for $10,000, it's worth $100,000, you die, your son inherits it. The IRS forgives all of the pre-death appreciation. Technical way of saying that is, the IRS allows you a step up in cost basis, or where you started, to the fair market value at the date of death. So the son now has a basis of $100,000, sells it for $100,000, $100,000 minus $100,000 is zero, still got the same $100,000 in his pocket, no tax to pay. That's what we're talking about with step up in basis.
And so one of the interesting follow-ons to that is step up in cost basis applies to assets that the decedent owned, as opposed to the decedent gave away. And so, a lot of people say, well, I'm going to gift my children, my house before I die. That may be a bad idea for income tax purposes, because the recipient of a gift takes over the tax basis of the original owner and does not get the step up in cost basis.
So,
Can I make sure I understand that? That's exactly what I'm concerned about. Would it be better for me to keep a hold of my place up in Walnut Creek and get a renter to come in and bring me income? And then when I die, my kids won't have to pay as much taxes as if I sell it now and have to pay taxes?
For income tax purposes, yes. So she asked, should she keep her rental in Walnut Creek until she dies, and then let the kids sell it and not pay any tax? The answer is yes. If she sells it now, she has taxable gain. If she gifts it to the kids and they sell it, they have taxable gain no matter when. So you do have to be careful about how you order those events.
There may be other factors involved, obviously, but based on taxes, absolutely.
oh, the step up basis, is that true if it's in a trust too?
Yes.
If it-
Yeah, because most trusts, correct me if I'm wrong, have wording along the lines of, property that's put in the trust maintains its character, whether it was separate property, community property, and such.
So for what I generally refer to as the Garden Variety Living Trust, nothing wrong with those. Let's take a straw poll. How many in here have a trust? Okay, so about half to two-thirds maybe. Okay, and most of you have the Garden Variety Living Trust, which is fine. All right, it might be, usually is. It's proper for the purpose. Then, from the IRS standpoint, you own it. Trust doesn't exist.
Can I just ask, how many people have had that trust reviewed? Financial person? Anybody? Okay, well,
How many people have had their trust reviewed in the last, say, 10 years? Yeah, if your trust is more than 10 years old, as Merv kind of mentioned at the beginning, there may be provisions in there that are no longer needed and actually may be detrimental to the estate planning strategy.
Yeah, so what was right for you 10 years ago may or may not be right for you now, because your health changes, your wealth changes, your kid's situation change. Everybody says, oh, nothing's changed. Well, those three things always change.
And tax laws change.
And tax laws change.
There was this little tax law that happened 2 years ago called Secure Act, and Secure Act 2.0, and has flipped some of the estate planning strategies on their head in terms of, do you gift your children assets that are, in your trust or in your retirement plans? What's the best way to do it? And retirement plans are very tax inefficient strategies on the way out. Because if you have an IRA, a 401k, and your children inherit that after you die, they still owe income tax on that money coming out. And because of Secure Act, they have to do it over a 10-year period. And so the conversation is now turning in financial planning circles to, well, maybe you should gift the retirement plans to the charity and give your children the non-qualified assets, so the house, the stock, account, because they get a step up in cost basis and they can sell it the next day with no tax.
Oh, go ahead. Sorry.
Oh, we had the Q&A part. I just wanted to, I have a question
Oh,
when
well,
we're
go
at the
ahead and
Q&A
ask
part.
I'm not that formal.
I didn't know who you are.
See me during office hours.
If you do a transfer on death at a bank account, that's still taxed.
So
Doesn't
yeah,
matter who owns it.
the form of title, trust, if it's a garden variety trust, individually, POD, pay on death, transfer on death, has really little to do with income tax. It has to do with title transfer, probate, that type of stuff. And
So it would avoid.
you got a cubby hole over here and you got a cubby hole over here, and they don't usually cross.
Right, so the question was around a transfer on death designation or payable on death designation on a bank account or a stock account. It is a way, as Merv mentioned, to essentially create the same thing the trust would do without a trust, because you're putting a beneficiary designation on that account that avoids probate.
And that's a perfect example of, when I said, whatever you can do with a trust, you can do by other means. Transfer on death, pay on death, avoids probate. But you can do many things with a trust. So if you have a transfer on death on your securities account or your bank account, $1 million, whatever it is, and it pay on death to my son Bill. Okay, we're not being as Bob. So if Bill dies before you do, then what happens? In a trust, you can have successors. Can't do that on a pay on death account. What happens if you lose mental competence? Pay on death account doesn't really do anything for that.
If you have a transfer on death deed on your property, and you have the beneficiary take it over on the title, do they get that step up on the increase of the amount that, say you bought the house for 100, it's worth 5, and then they're gonna start at 5 for their 250 limit when they sell it at 750 or something like that? Okay.
Yes, so I don't mean to steal your thunder, but I wanted to add, anything that you own when you die, did you own that house which had a transfer on death deed? Yes, you did. Anything that you own, with very few exceptions, when you die, gets a step up in basis. Doesn't matter whether it's pay on death, doesn't matter whether it's in the garden variety trust, doesn't matter whether it's in your individual name, etc. Did you own it when you died? That's the question.
She's been very patient.
Prop 19.
Yes.
Prop 19. Everybody wants to know what Prop 19.
You missed that seminar.
I'm sorry.
We had the man here.
We could have a 2-hour seminar on Prop 19.
I'll let you take it over. Yeah, really.
So again, one of those things where there's, before and after. So the rules totally flipped because of Prop 19. One of the good aspects of Prop 19 that a lot of people don't talk about is now every county in California participates in the transfer capability. Pre-Prop 19, there were only, I think, 6 of 58 counties that you could sell a property in one county and buy a property in another county and transfer your property tax basis. Now it's the entire state. So that's a good thing. The bad thing is you're limited to $1 million of increase. The good thing is the old rule for age 55 plus was unlimited. So you could buy the house for, $300,000 is worth $2 million today, and you could do a one-time property tax transfer to a new house that you bought for lesser value than what you sold and maintain your property tax basis. We're talking property tax now, not income tax, not estate tax. So there's 3 separate topics. Under Prop 19, if you, let's say your property tax basis is 300 and the fair market value is 2 million, you can only transfer essentially 1.3 million to the new property. that 700,000 additional gets an increase in property tax assessment. But if you bought a house for 3 million, you're just adding that, you can still transfer that million, you just can't, you get taxed for anything above, so you can buy something more expensive than what you sold and maintain your property tax basis on the house you sold to the new one with an increase for the additional value of what you bought. It gets really confusing, so, you know,
Is that only for your principal residence?
principal residence only.
So not only is it only for your principal residence, so you had to have the homeowner's exemption on it. Homeowner's exemption is worth $70 a year, big deal. But you had to have it, right? Now you've died, your son takes it over, I think it's within a year, he has to move in and get the homeowner's exemption on it. So it cut out rentals, basically.
Finish with homeowners. Does everyone here know what that is? Do you all have a homeowner's exemption?
So if you look at your property tax bill, in the upper right hand, it should say, you know, assessed value, buildings, land, and then just below that it says homeowner's exemption minus 7,000. And then assessed value is, you know, 7,000 less than whatever the first two lines were. That's the homeowner's, if it doesn't say minus 7,000, you don't have the homeowner's exemption on record with the county assessor.
Now, that's not $7,000 tax savings.
No.
Because, you know, you take 1% of that or whatever, so that's where I come up with $70 or so. So it's not worth a whole lot into your pocket, but for this purpose, it's essential.
And
How do you get
explain
it?
You just apply for it.
So there is a form that you can send in to the county assessor, but there's an online version and a form you print out to have them apply it to your property.
Can you guys talk about why they should have that?
The homeowner's exemption?
Yeah.
Well, I guess you save $70 and, you know, have a happy day at McDonald's. Or I guess, you can potentially pass that on to your kid or kids with the old tax base, property tax base, depending on what the value is now and what the value was before, and whether they're going to move into it, and about 55 other things, I guess. But I think that's it. Do you have anything to add to
So,
that?
well, that's one of the issues with Prop 19 is to get the $1 million exemption in the parent-child exclusion. You, the original owner, have to have had the homeowner's exemption, and then the child has to move into it within a year and put the homeowner exemption on it. So it's becoming their primary residence as well. If they do not make it their primary residence within 1 year, that $1 million property tax exclusion goes away, and they get a full property tax reassessment.
Yeah.
Most banks, when you get a loan, will already do the transfer for you and file it. So a lot of people don't seem to know if they have it or not.
What transfer?
The homeowner's exemption, most banks, when you get a loan, have a document in there. So a lot of people, if you have a loan on your house, you probably do, you'd want to double check.
Yeah, all you have to do is take a look at your property
Yeah.
tax bill. That's
Right,
That's
and the circumstance would be, it was your rental and you moved back into it, and the county doesn't know at that
Right.
point that you've remade it your primary residence, and so you'd have to file for it. There's also there's a low income exemption, which is a lot more than $70. So if you have a low income, your property tax exclusion currently could be almost $400,000. There's also a disabled veteran exemption. But, so if you have a disabled veteran living in the property, that can be a significant property tax exemption.
I wanted to go back to when your spouse dies and you get to step up. What documentation do you need for that?
The step up in cost basis?
Because maybe 5 years later, then you sell the house. What is the documentation you need for that step up in value to prove that?
So that's
repeat the question.
So the question is, what documentation would you need to prove the step up in cost basis if their surviving spouse sells the property, say 5 years later after the first spouse passed away? So we do get that. And the answer in short is something in writing is better than nothing. And so typically what I recommend to clients is you go to your realtor and have them do what's called a market value assessment, and they print you out a report that says, this is what the value of your house would be on the date that the first spouse passed away. IRS will generally accept that. If it's, you have a $20 million mansion, you probably want to spend the, $500 or $700 and have it actually appraised by an appraiser. So, it's relative to what is the tax risk. The lower the tax risk, if, the house is worth $500, $800 million, the IRS probably isn't going to, question the market value assessment just to say, here's the high water mark, and then, you have 250 above that. But if it's, the $20 million, $50 mansion, you want to get an actual appraisal.
Yeah, so we tell clients when, we've got a death case, basically, you have two ways to get a valuation, and you want a valuation. Doesn't mean you can't go back in time and get the valuation, but it's easier generally if it's concurrent, contemporaneous, I guess is the term. The two ways are real estate broker's estimate of value, I think it's called, or an appraisal. The first one is free, the second one is not. What does it cost for the house down the street? I don't know, $450, $550, something like that. $20 million mansion, might be a little bit more than $700, I don't know. Which is better? Well, I think the appraisal is probably better, but which will work? If you have a house in a subdivision where there's 15 other houses that look identical to yours except for the facade of the front, a real estate broker's opinion of value is fine. The big thing is, and we have to send it back to the broker sometimes, is we need a date on it as of what date, and we wanted the date of death, on your letterhead, and we don't want a range, we want a dollar number, okay? Because we get the ranges all the time. That doesn't do us any good because what's the cost basis? We don't know. To my knowledge, you don't have to submit that to the IRS. When you eventually sell the property, you're going to fill out whatever schedule it is that you fill out for capital gains, but you don't have to put in the appraisal, unless, of course, they audit you, and then that's what, we've got, a very simple system here. It's on the honor basis, on fear of going to jail, so.
Bob.
I'm going to ask, go ahead.
Question about if it's not a spouse, if it's mother-daughter living there and the place is in my name, if I get hit by a bus or something, then it goes to my mom with the will and everything, but would I speak with you to come in and do that?
To get a broker's price opinion?
Yeah.
Yeah, you can just really call me.
Okay. What if it's a fixer-upper? And then is it gonna be afterwards, or because we're still in the process?
What we're gonna do is look at similar properties,
Okay.
square footage, that are sold in the area,
Great.
okay? And we get a list of 10, right? And it's like Murph said, don't give me the range,
Right. Give
tell
the
me which
number.
one it was. And, because I'm lazy, I'll probably pick the median price.
Okay.
Because I'm not gonna go through it and look at what needs fixed and those sorts of things, because what you think needs fixed, somebody else doesn't think needs fixed.
Well, and that's really an appraiser's job. So if you want to get into that depth, well, all right, you're going to pay $350, $450, $550. Does it really matter? It's going to cost $30,000 to fix it up. Well, what does that come out to in capital gain tax? Probably not all that much 10 years later.
Okay. Thank you.
And it does depend on magnitude. So, the IRS is a business, and they have to look at, is it worth it to come audit your sale for, $500,000 when we could go look at one for $50 million? And there's a much bigger tax gap that, we can collect tax on.
Okay, thank you, thank you, thank you.
I have a question about, you had commented earlier that more than $150,000 that's not in the trust means probate. I'm from Minnesota, probate's a piece of cake there, not expensive.
Welcome to California.
Exactly. So I moved here, everyone's like, you don't wanna do probate, it's like 30% of your estate is the cost. So I get a trust, I put my house in the trust, but if I have my IRAs, which can't be in the trust, and stuff in beneficiaries, can I avoid probate that way, or my daughter avoid probate, or? I didn't understand the $150,000 not in trust, because I was told I can avoid probate if I have a trust with my house in it, and all my other assets have beneficiaries.
All right, so may I take that one? California has, reportedly, I haven't checked, but this is what everybody tells me, a more stringent probate system than a lot of other states. Not all other states, but a lot of other states. 30%, that's,
An exaggeration?
yeah, let's use that term.
Is it worse?
Whoever told you that, yeah, let's use that term. So, probate fees, I mean, even in this one that's going forever for me, the attorney gets paid at the end, so what are his fees, or her fees? It's a statutory fee, okay? There's a formula, right? 2% of the value up to $1 million plus $3,000, so there's an extra $3,000 on there. Above $1 million up to, I think, $10 million, it's 1%, okay? Not 30%, all right. So now the executor gets the same amount. Well, if the executor is your kid, and your kid is the only beneficiary, kid isn't taking any compensation, right? All right, the probate referee gets something. What does he get? He gets 1/10 of 1% of the value up to $10,000, I think it is. You got court fees. All right, so the court fees are, I don't know, $1,000, $1,500 by the end of the line. You file this, you got to pay $15. You file that, you got to pay $15. There's an initial fee of, I don't know, $500. You got to pay the bonding company. What do you pay the bonding company? 30%? Well, I guess it could be if you had a $3,000 estate. But that's not what we're talking about, right? All right, let's get back to your other question, $150,000. It's actually not $150,000. It goes up every year. I don't know, I think it's $166,000 or something like that. But it doesn't count a whole lot of things. So I think you brought up your IRAs.
IRAs.
Yeah, it doesn't count your IRA. So it doesn't count anything that has a specified beneficiary, which IRAs typically do. Your pay on death bank account, that doesn't have it. Your transfer on death deed, that has a beneficiary, so that's not going through probate.
Okay.
Doesn't calculate into the $150,000, $160,000, whatever it is. What else wouldn't count? Life insurance benefits generally aren't going to be counted. What have I missed?
Well, and the underlying assumption is...
Oh, and the trust stuff, of course.
Correct.
Yeah.
The underlying assumption, which you mentioned at one point, is that everything is up to date.
Sure.
I did have a case, client's parents passed away, and the parents' IRAs had named the opposite spouse as primary beneficiary and had not named a secondary beneficiary. So that this is the horror story. It ended up in probate. Why? It shouldn't have. Because mother passed away, father became the beneficiary. Father did not change title to himself of the IRA and then passed away without naming another beneficiary. And so the mother's IRA became property of the father, even though he never retitled it and did not re-beneficiary it. And so all of a sudden this IRA, which is only like $150,000, ends up having to go through the probate process because the investment company is saying, no, it belongs to the estate. It does not belong to anybody else at this point. You need to figure it out.
So yeah, keeping things up to date is essential. We often say, 50% of the battle is getting the trust done, if a trust is appropriate. The other 50% is keeping it all up to date, right? But Joe, you bring up a circumstance that prompts the story, right? So this 80 asset, it's over a year probate thing. So what really happened was back in November, a year ago, I guess, mom died. This is actually a second marriage. Mom died. 4 months later, dad dies. Now, they had been my clients since time started, right? They only wanted a will. I saw them maybe 2 or 3 times since. You really probably should have a trust. No, we only want a will. You might want to think about, no, we only want a will. Okay. So, she dies. House is only in her name, not in his, owned by the sister or something like that. Nothing nefarious about it. That's just the way it was. All right. So, I get together with him, and all of a sudden he wants a trust because, he sees the truth, right? We don't get everything done because he dies shortly thereafter, so, it wasn't done. So now, you want to talk about probate? So we've got a probate for him, all right, because everything wasn't in the trust. We've got a trust settlement, so that's case number 2, right? We have to get the house, really half the house, from the deceased wife's name to his name so that we can get that into his probate. So that's a 3rd case, not a full probate, a kind of a partial probate. Then we got to do you'd call it a financial report, we call it a fiduciary accounting, so that everybody knows where all the money went for the probate. Then we got to do one for the trust. That's 5 cases by my count, plus, I don't know whether I counted the probate or not, it might be 6. I lose count on this thing, so keep it up to date, okay?
Next year, one of the things we're gonna do, and hopefully you guys will join us again, is we really wanna emphasize making that trust work for you. Because it's not one of those things where you have to do a lot of work and don't get anything out of it. You may not be around to get anything out of it, but it's the people that you left behind that now have to figure out, what are we gonna do? Do you want that kind of legacy? Or have a legacy of saying, you know, Mom and Dad really took care of us, look at this, we're gonna be doing it. And seriously, with how quickly these laws are starting to change, it's nice to have somebody you can pick up the phone and ask, right? As opposed to trying to figure it out on the internet yourself. There's a lot of stuff on the internet. Some of it's not worth it.
And all of it is 100% true.
You need to have somebody, and I'll use a legal term now, liable for what goes in that thing. And that's what these guys, that's how they get paid.
So let me just add to that. I have a phrase here. Don't get your legal advice from the notary public. Don't get your medical advice from the CPA. Don't get your tax advice from the real estate broker. You know, go to the right person for the right job. And I think that's essential. But we did have a question over here.
I did. If you've refinanced your house since your trust, how do you make sure that your home is in your trust?
Doesn't slop out. So
Yeah.
the example is refinances the house. How do we make sure that, you know, it was taken out of the trust by escrow probably. How do we make sure that it's back in? You can have someone like Rick check the records. But what we do, I mean, let's say you come in a year later and we're going to check. We're going to go online to the title insurance company that gives us access, not going to give you access, but gives us access to their records. We're going to take a look, or ask you to take a look at your property tax bill. Does it say trust or TR on it or something like that? You know, if you got both of those, is it a guarantee? No. But it's a good 95% predictor from our point of view. You know, I'm not going to guarantee it unless we go out to the title insurance company, pay them money to then issue a title insurance policy guaranteeing the title is as they state. Well, you probably don't want to do that because that can get pretty expensive, you know, several $1,000s at least. So, you know, 95%, that's pretty good odds from my perspective. Now, where did I get 95%? Blue sky, okay? So don't quote me on that.
I agree that the property tax bill is probably step one.
I'm sorry.
Your property tax bill. Look at your property tax bill. What does it say? Who is the owner on the printed property tax bill? If it says, you know, the Marcia and Stephen Trust, that probably is accurate. If it does not say that, if it says Marcia and Stephen as joint tenants, that's probably a problem.
But it may have Marcia and Stephen TR or TEES or something like that, trustees or trust or something like that, which would be a darn good indicator from our standpoint.
One just offshoot here. What documents should someone have secured if they intend to age in place? And I'll just, anybody that wants to step right in on that, please do. Because I don't know.
Okay, I see everybody looking at me, so. Rick actually gave us the draft questions. I don't know if they're exact, but, you know, so I wrote some notes, and of course I can't read them. You know, if you're going to age in place, you probably want to post physician's order for life-sustaining treatment, I think is what it stands for. Always on pink paper, okay? And it's on, whoops, there goes my notes. It's on pink paper so that when the paramedics rush into the house to save your life, they can spot it easily. You know, you put it on your refrigerator with a magnet or that type of stuff. And it's exactly what it says. It's signed by the physician, it's signed by you. You know, I don't want to be resuscitated or whatever it is. You want a medical directive. Other names for that, power of attorney for health care. Medical proxy, all the same thing. Three different words, same thing. So you definitely want that. I think everybody should have that. If you actually own something, you know, like a bank account or something, then you at least want a power of attorney, a durable power of attorney for finances or assets, whatever it's going to be called. Depending on your wealth, if you're worth a couple $100, I think the statutory form is going to be just fine right off of the internet. If you're worth 10 million, probably not. You know, and there's a gray line in there somewhere between the two. You know, again, do you even need a will? So, I mean, I said we deal with Medi-Cal all the time. What I learned 30 years ago, we call planned poverty, right? Planned poverty. So, you know, how do you get rid of your assets so that you can meet the net worth requirements for Medi-Cal? You give stuff away, you have to give it in a certain way, blah, 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 blah. But if you give it all away, and you got a $2,000 bank account with a pay-on-death beneficiary, do you really need a will? For what? For their couch? Yeah, but you can have one, and there's what's it called? It's not called a statutory will, it's called a State Bar of California will. And you can get that right off of the internet, right? You just got to read the instructions, which is a challenge for some people, but nevertheless. You know, if you've got something significant, whatever you think that is, in my mind, that's maybe more than $250,000, something like that, I don't know. Then you probably want a trust, right? And to go back to something else that we've talked about over and over again, you know, over the last hour, how bad is probate? Well, if 99% of all your assets are in the trust and are going to avoid probate, and you got one $50,000 bank account, or let's put it over the number, the limit, $170,000 bank account, is that all that bad? Is that awful? Is your daughter or your son going to run around screaming that the sky is falling because they got $170,000 probate, but they got $10 million outside of probate? You know, I mean, put things in perspective. So that's what I would say would be the documentation. But the other one is, do you know where it is, and can you get it? Right? Can you get it? And up until recently, we would, you know, client comes in, signs everything. We would send out the wet copy ink originals. Okay, everybody knows what that is. I hope that, you know, that's the one that you actually signed, right? And we would have photocopies of everything, right? We put the photocopies in this nice-looking binder, and we'd send it out in this big envelope by FedEx or UPS or whatever. And, you know, 6-7 years later, they'd come in, and that envelope had never been opened. You know, we always said, you know, put the ink originals in a safe deposit box or fire-resistant facility. Keep the copies on the bookshelf in the bedroom, or, you know, whatever it is. My dad had an attaché case. He said, you know, if anything happens to me, attaché case next to the desk. My in-laws, who I always make fun of, they had a shoebox up in the closet, right? It didn't really matter as long as everybody knew where it was, you know, and that type of stuff for the copies. We don't actually send out copies anymore. We do it digitally because almost everybody is digitally. I mean, if you beg and plead with us, we might do it, but it takes so darn long that you know, it was just too labor intensive.
Yeah, I would agree, you know, making sure that, and this requires some advanced planning, but have kind of that emergency plan. So we have clients that they have, you know, the old 3-ring binder with a copy of the trust in it, a copy of, you know, kind of asset location, a copy of that emergency plan. And so one client that passed away probably 10 years ago, you know, the husband had spent, you know, a lot of time getting everything together. And page 1 of the 2-ring binder just said, "Call Joe." And so, you know, the couple of weeks after he passed away, the wife calls and says, "Well, you know, Jim said call you. What do we do?" And my first question was, "Well, do you have the binder?" "Yes." "Okay, bring the binder in, and then, you know, we can go through everything."
And that was always our theory until the binders started filling up. Because we did another power of attorney, because you don't want to have what we call a stale power of attorney, because banks basically hate lawyer-drawn powers of attorney. If it isn't on their form, they don't want to recognize it. Doesn't mean they don't, doesn't mean they don't have to, but it's problems, right? So we would always we would take that argument away that it was too old for them to recognize by, you know, redoing it every 2, 3, 4, 5 years, whatever it was. So now there's another power of attorney in the binder. Well, you know, think about binders when you were in grade school, they fuller and fuller and fuller, and now you'd be on your second binder. all that kind of stuff. And, well, what do I throw out? Well, come on in and we'll, ferret through. Don't throw it out yourself. I had one client who was moving into assisted living out of her condo, and, she was obviously getting rid of things, right? We were talking about, cleaning out, or whatever term you use, downsizing. And she was throwing things out. And she called me, and I don't know why she called me, but probably for a review. And I said, well, do you have that 3-ring binder? Uh-oh. I think that went to the shredder. Well, what about the originals? Uh-oh. I think that went to the shredder. And as best we can tell, it did, so we had to redo things. So we don't do copies anymore, okay? We only do originals. Put them in a fire-resistant facility. I used to have mine in a safe deposit box down at Union Bank. They were never open when I wanted to go, right? I wanted to go at 7 o'clock at night. Unreasonable on my part? Oh, absolutely. But they weren't open. I wanted to go on Sunday. They were closed on Sunday, right? So I said, all right, this is not working. So I bought a fire-resistant facility for home. And at first I started off with a safe. Well, thinking, right, didn't buy. Safes are expensive. Fire-resistant safes are expensive. And I finally came to the conclusion, who's going to steal my will or trust? Who cares, other than my family, right? So I said, well, why don't we just get a fire-resistant file cabinet, right? With one of those locks that any of us could pick in 10 seconds, right? It's, I guess it's asbestos. I don't know what it is. It's heavy as heck, because I had to move it from the front of the garage into the laundry room or wherever we keep it. And what you do is you get what are, there's 2 things you have to worry about if there's a fire-resistant safe deposit box, or fire-resistant file cabinet. Fire, right? That's what you're worried about. 2 things you have to worry about. Fire, and what puts out fire? Water, right? So the fire department is there hosing everything down. What does that do to paper? It destroys it, right? So you got the fire-resistant file cabinet, and then you buy what are essentially glorified sandwich bags. They're really thick and they're big, and you put them in there because they're waterproof or whatever. And you put that in the fire-resistant facility, and hopefully you're good.
And then you have laminated documents.
And then you have laminated documents. That's right. Absolutely.
Because the sandwich bag melts onto the paper.
And if you have a better solution,
well, so my parents lived out in Palm Springs for years, and I was after them for years and years. Dad, you got to get a safe deposit box. Dad, you got to. So finally, he's like, Joe, you'll be so happy. I got a safe deposit box. The bank burned down the next week. So even the best laid plans never are perfect. But here's the cautionary tale. When the owner of a safe deposit box passes away, what happens? It gets locked.
Well, no, it doesn't. All right. It used to. Way back when, the inheritance tax people, that was the California version of estate tax or death tax, under their regulations, they had to freeze it or lock it or whatever. I'm going to go back. It does and it doesn't. How's that? But that went away years and years and years ago. So,
but we still have problems. I still have clients, current day, that have that problem.
Absolutely.
Parents had a safe deposit box. We have the key. Bank will not let us in.
Yeah. How do you get in? So there's really 2 ways. So you can use this affidavit that we were talking about if stuff outside of the trust that's potentially going to go through probate is less than that magic number of 160, whatever it is. So that's one way to do it. The other way is there is a statute in California that says that if you believe that you are the successor, the named executor, whatever, you can go to the bank with the death certificate, and obviously your own driver's license, and you can get into that safe deposit box with one of the bank employees looking over your shoulder, okay? If you find a will, you can take it out. If you don't find a will, then you can't. They take a copy of the will. Forgot what they do with it. So you can get in there for that purpose. And obviously you can take an inventory of what's in there so that you know, which is the real reason we're going in. So that generally solves all problems because now we've got time to file that probate if we need to. Once we have filed a probate, we have an executor, they have the right to go in there. So, it depends on what you're looking for, I guess, as to whether that's, oh my God, an urgent problem or we got a simple workaround.
The solution to that, have a joint safe deposit box with my daughter?
Sure.
and she can go in there and get my stuff?
Right, and that's the other solution. I don't know whether everybody heard, but you put someone else on there, whether it be your daughter or son or whoever it is, so that they're a joint signatory, I guess. And as Joe pointed out before, and what's the risk of them taking all of those jewels that are in there in the gold bullion to Argentina? So again, nothing perfect, but that's certainly another workaround. Absolutely.
Are life estate deeds still being used for naming a beneficiary ahead of time that you want to have taken over the property, and then you pass away and it's all avoids probate and that kind of situation?
Say that again.
A life estate.
A life
deed.
estate?
Oh, a life estate. Okay, that's what I didn't hear. All right, so you got a life estate deed. You got the life estate, and then it goes to your son. Is that what you're talking about?
Yeah.
That type of thing.
Yeah.
All right. So what's the question?
The question is those are still.
Do those still work? Do those still work to avoid probate? I assume. Yeah. They work. You can even do a revocable life estate, and that works. It's been around since 1913 or something like that. So yeah, all of those work. Whether that's a good idea, separate question. What are the tax implications? Separate question. So you can't say this is the answer. It's for what purpose?
Well, you said how long it takes when you have property and it goes to probate. How long does it take, let's say if I pass away and I have a house, how long would it take to settle it if I had a trust for the property? What is the time frame?
So how long would it take if you had a trust and you die, the house is in the trust, how long to close the estate, I guess is what you're saying. So you got the house is worth $2 million. If it's around here, it's probably in the ballpark. And you got $300,000 in the bank, and that's basically it. Everything titled in the trust. All right, so in California, the settlement period is a minimum of 4 months. We're going to have everything done in 2.5, 3, 4 months, somewhere in there. In a case like that, assuming there's no problems. But the other issue is, how long is it going to take to sell?
Depends on what the market is right now for a $2 million house.
Maybe they don't sell it, maybe they make it into a rental, but just to try.
All right, so if you're talking about only on the legal end, but not selling it and distributing the cash, which is a whole separate issue, obviously. Yeah, I mean, we're talking about 2, 3, 4, 5, 6 months, somewhere in there, generally. Assuming that there's no title problems, assuming that, making all sorts of assumptions. I'm sorry, I didn't hear you.
So it's a pretty simple process, you're saying it'll be like a waiting period and then it'll just be re-recorded into.
So you added to my statement, this is a simple process. No. All right, so no matter what you have in place, trust, no trust, life estate, transfer on death, doesn't matter, okay? There are always loose ends to tie up when someone dies. Always loose ends. So what are the loose ends? You got to deal with the taxing authorities. IRS, Franchise Tax Board, County Property Tax. So that's one. You got to deal with creditors. Oh, I don't have any creditors. Everybody has creditors, okay? You pay off SDG&E today, you owe them tomorrow. They're a creditor, right? Doesn't mean you're behind. It just means they're a creditor. You got beneficiaries. Do you have more than one kid? If you have more than one kid, there's the possibility for conflict. Who else do you have? That's basically it. Oh, and then you got the assets that you got to deal with. So all of these things have to be dealt with. Sometimes it's more complicated, sometimes it's less complicated, but there are always loose ends to tie up. Another name for loose ends to tie up are issues, okay?
And I can vouch for the loose ends. You get that stuff, it's just, now what do we do, right? And we're usually calling guys like this.
So let me, okay, we got questions? Yeah, go ahead.
I want to jump back to earlier in the discussion, and you said something about IRAs being taxable to the heirs, and so not putting them into a trust. What do you do with them?
Well, yes, you do not put an IRA or a retirement plan into the trust, meaning you do not retitle it into the trust. However,
what would happen if you did?
If you actually transfer title of the IRA or retirement plan to the trust, it's a taxable event for income tax purposes. So it's considered a distribution of the assets, taxable event. You don't want to do that. However, you can name the trust as beneficiary. That has other problems. But that can be allowed the assets to pass to the ultimate beneficiaries. The ultimate beneficiaries of a retirement plan, because it was pre-tax assets, and we're not talking Roth IRA or Roth 401k yet, that's a relatively new invention, but for pre-tax assets, it's called income in respect of a decedent, IRD, and it's still taxable to the beneficiary, meaning you inherit mom and dad's 401k, IRA, 403b, 457, whatever tax qualified plan you want to name. As you take the money out, you still owe income tax on that money because mom or dad got a deduction for putting it into the plan when they were working, during their early years.
And a 10-year
Is
drop
there
dead.
another alternative?
Is there another alternative besides not paying the tax? Yes, you can donate it to charity. So that's why, and my comment was, the Secure Act has kind of flipped the script on that planning strategy of maybe donating the retirement plan assets to a charity is a better overall solution to minimize tax to the heirs than leaving the heirs the retirement plan and giving them the non-qualified assets, the house, the brokerage account.
Let me interject there, because we have clients who come in from time to time, and let's say they have $500,000 in IRAs, retirement plans, whatever. They have kids, but they also have charitable desires, so in their trust, they're leaving $500,000 to charity and all the rest of the kids. So now the kids are named as beneficiaries of the IRAs. So the kids are getting this taxable item, this IRA retirement plan. The charities are getting the non-taxable items. See a mismatch there, right? So what we say is, well, let's just name the charities as the beneficiaries of the IRAs because they don't care. They're going to take it out. No tax, right? And we're going to make the trust assets, the other $500,000, let's say, go directly to the kids because there's no income tax on that, and inheritance is not taxable income. The interest that it earned perhaps is, but the actual principal isn't. Assuming that we're below the death tax limit of 12 million something or other, we don't have to worry about that, and it has nothing to do with property tax. So, we want to get the proper match for who's going to be the proper beneficiary for an asset. Again, why you tend not to want to do this yourself, because you saved some money, you didn't have to pay the darn lawyer, but you cost your kids, $50 billion or whatever. Good job.
Is there a dollar limit on your IRA that's not going to be taxed?
Yes, 0. Well, not entirely true. So a retirement plan could have after-tax money in it.
If I live long enough, those distributions are going to start eating it down.
Not entirely. So going back to this tax law called Secure Act that passed a couple of years ago, there's now a 10-year distribution period for non-spousal beneficiaries. So if you're inheriting your spouse's IRA or 401k, you just take it over as if you were the original owner. When your children or grandchildren inherit it, they have to distribute within 10 years. They must distribute within 10 years.
And as it comes out, it's going to be taxable.
And if they don't distribute within 10 years, there's a 25% tax on the amount they did not take out.
Plus the regular
Tax, yeah.
Let's go back here, because you've had your hand up a long time.
I have an intense question. I don't have property. All my money is in IRAs. But I have a living will. I have a durable couch and a house repairs there. I had it all done between 15 and 20 years ago in Florida. So it is still viable here. I mean, if I read it, it's okay except for my daughter's name has changed because she got married. So her last name. So do I need to redo the whole thing?
All right, so I have learned the hard way that I never, ever answer a specific individual factual question in a situation like this. What I will say is it depends on the circumstances and situation. Whether that's sufficient for you or not is not something that I'm prone to answer in a situation like this, sorry.
So I'll go out on a limb and say most trusts, they state in the document what state tax laws were applied when it was drafted. If it says Florida and you live in California now there may be problems. So it should be reviewed by a professional to determine, not that it's not legal, but does it apply to current California estate probate tax rules?
So there's a difference between, as you just pointed out, there's a difference between legally valid and effective, I guess. But to go back to something you said, ma'am, your daughter's name has changed. That's rarely a reason for us to say we got to update it, because that's just for identification. We can track that back. That's not really a problem.
So what if you move again, like if you do it here in California, then you move again?
Every time, so I mean, we get that question from our clients. I'm going to move to another state. Do I need to have this reviewed? Well, the simple answer is yes. Okay? So every state has its own idiosyncrasies. Okay? California is different than Arizona, is different than New York, etc. And I don't know Arizona law. I have a general running knowledge of it, but not at that depth level. So, one of the first things you need to do is to see a professional in that state. The next question is, how do I find a professional? I've got some things on my website on how you do that, if you need to. Client comes in and says, I need a trust. Okay, I'm moving to Arizona 2 months from now. Well, probably you don't need a trust here, okay? Unless you think you might die in the next 2 months. I mean, it's a risk, sure, but probably not.
Getting back to retirement accounts, if you're taking your required minimum distribution and you die, the amount that's left in the account goes to the beneficiary. Now, do they have the option of taking either a lump sum or doing required minimum distributions like you were?
Is it a spouse beneficiary or
The beneficiary.
So it does depend if it's a spouse or a non-spouse. So the question was, you're already taking your minimum distributions from your IRA because you're over age 70 and a half, which was the old rule, now up to age 75 under Secure Act 2. And you pass away, the beneficiary, so there's two types of beneficiaries, what are called qualified and non-qualified. The qualified beneficiary is your spouse or an inheritor that is less than 10 years older than you. So like you name an older sibling. They can maintain your current distribution strategy. So continue required distributions. Anybody else, a non-qualified beneficiary, so your children, your grandchildren, they have a 10-year window that they must withdraw over. And they have to take annual distributions, and by year 10, 100%.
Okay, but they could take 100%.
They could take 100% year one, yes.
Okay.
And then it just becomes an income tax strategy question of, does it make sense to spike your income? Add $1 million to your income in 2023, or spread it out over 10 years.
We're going to stop there, because they're going to throw me out of this room, and I'm not coming back. Remember, next month?
Rick, can I just mention that I do have some flyers up here on Medi-Cal if you're interested. Medi-Cal's best kept secret, so feel free to take one.
And by the way, I'd highly recommend that. I've learned a lot from talking to Merv, just a little bit. Did anybody learn anything from these guys today?
Yeah.
All right, great.